Hello traders, welcome to High Fund Investments. My name is Regan and I'm here to take you through position sizing. I put my emphasis on position sizing because it is very important as a trader to understand how much you risk per trade, what is your risk appetite, how much you lose, how much you make in profit, and how it all came about. Managing risk helps you to trade different forex pairs, be it volatile, be it non-volatile, because many traders out there want to trade different currency pairs, but they cannot apply the right position sizing. So here to take you through the position sizing, its importance, and the right way to do it to ensure your profitability in the long run. For many traders out there who want to grow small accounts, to grow a small account, you need to apply the correct position sizing to make sure you do not blow it before it grows. That means applying the correct position sizing. If you want to pass an FTMO, if you want to be a prop farm trader, you need to apply position sizing correctly. There is no way you can farm, there is no way you can pass the FTMO challenge or any other prop farm challenge without understanding the correct position sizing. The correct position sizing as a prop farm trader. If you want to be one and pass the challenge, you need to understand position sizing. In a matter of time, let's go down into how to calculate position sizing on different accounts, different currency pairs, and how much you lose, how much you make in profit, knowing you trade like a pro. Let's take a scenario where your account is, I have $500 account. You have 500 USD in your account and you want to trade GBP JPY. You want to trade GBP JPY and you want to buy that pair. You have confirmed an entry. You are taking technical analysis. The system is giving you an entry on GBP JPY. GBP JPY, in this scenario where your account is dominated in the USD currency and you want to trade a currency pair which is GBP JPY, with the trading GBP JPY, that means the quote is in the Japanese yen. That means therefore you need to exchange your risk per trade. You need to change the dollar's risk per trade into the Japanese yen over here. Your risk appetite, let's first calculate the risk down here. That is $500, 500 USD, 500 USD times 0.02. In my previous video, I taught you what 0.2 means. 0.2 means calculating 2% of the entire account. If you want to risk 2%, just multiply the number, just multiply the account by 0.2, 0.02. Therefore, you are risking 2% of the account. And in this case, $500 account 2% is 10 USD. With 10 USD, when you are trading GBP JPY, you need to first convert the 10 US dollars into Japanese yen. To convert Japanese yen into dollars, you need to look at the exchange rate of USD Japanese yen. Let's go down to the MT4 time frame. Let's go down to the MT4, MT5 trading platform to look at the exchange rate of USD JPY. USD JPY, the current exchange rate here at the ask price. Ask price here, it's what you look for when you want to convert the currency pair, which is 157.740. Let's convert. That means $10. That means 10 USD. 10 USD. 10 USD times 10 USD times 1 57.740, and in this case the answer is, let's pull out the calculator over here. Bang, here we are at $10 times 157.740. We get 1,577.4. Therefore, this is the amount. So therefore, this is the amount in the Japanese yen. This is the amount in the Japanese yen converted. Now, let's take a scenario where your technical analysis is giving you an entry and you are deploying a stop loss within 50 pips. Within 50 pips. Therefore, you get there 1,000, the amount you converted into the Japanese yen here, you converted, which is 1,577.4. You divide this amount by the 50 pips here, by the 50 pips. We divide by 50. This gives us 31.548. 31.548. So let's copy this. So this is the pip value. This is the pip value. That means for every pip, price is going to go up and down. Each pip value is going to be 31.548 in Japanese yen. When you are trading GBP JPY, you make a profit and then you make a loss in the Japanese yen. That's the reason as why you need to first convert all that into the Japanese yen to make sure you apply the correct position sizing. So this is the pip value over here. This is the pip value. This is the pip value. $31.548 is the pip value. So let's calculate the correct lot size, the correct position size to apply on your trading platform. The correct position size, the correct lot size to apply on your trading platform to enter that in the market. So first, you get this amount here. You get the pip value. Which is 31.548. We multiply that. We're multiplying that by the known units in the market, which is 10,000. Giving us so we get this times the known units, which is 10,000. We get this value. So this is the position size. This is the actual position size in the market. But we need to know the correct lot size to apply so that we get this position size over here and we do not lose more than the $10 we risked per trade over here on our entire account. So let us calculate the position size, let us calculate the right lot size to deploy, the right lot size to put into the trading platform. Let's get this value here. Here, this is the position size. This value is the position size. So let's calculate the right lot size to enter in the trading platform. MetaTrader 4, MetaTrader 5, to get the right lot size. So this is the value here. So after getting this position size, to calculate the right lot size, so we divide this by the standard, which is standard lot size, which is standard size, which is 100,000. So let's divide this by 100,000. So 3.15, or if we round off and we make it 3.2, this is the lot size you need to put into the trading platform. This is the lot size you need to put into the trading platform. 3.15 is the correct lot size you put into the trading platform to make sure you don't lose more than $10 on your account. To prove this, you just get, let us prove this value here. Let us prove this formula, which is 50 pips. 50 pips times the pip value here, times the pip value, which is 3, which is the 1.548, and then the value we get three 1.548 times 50 times 50. This is the amount in the Japanese yen. This is the amount in the Japanese yen that we converted recently. We are proving our formula. So this is the amount. So let us convert this back. Into US dollars to prove the formula. We divide this by the ask price. You remember the ask price, the exchange rate of USD Japanese yen, which is, we use the ask price, which is 157.740. So we divide 157.480 0.740. When you divide this on our calculator here, divide by 1.5.740, you get this value here. You see, this is just exactly $10. It is just exactly $10 that we have at risk in this scenario. It is just exactly $10 that we have at risk in this scenario over here. So this is how much you risked per trade. This is how much risk per trade by trading the Japanese yen in GBP JPY in pound yen pair. Let's go to another scenario. let's take a scenario where your account is dominated in another currency value. Let's say the account is, let's say your account is 500. You have $500 in your account, and this account is in pounds, and this account is in pounds, and you want to trade G, B, and you want to trade the pound dollar, which is the GBP, USD. And your technical analysis is giving you 10 pips. On the entry, we first calculate how much you risk. We get this entire value here, which is the account, how much you have the account, which is 500 pounds, which is 500 pounds. We first calculate the risk we put per trade. In this scenario, risk 2%. 2% means multiplying by 0.02. Multiplying 0.02. This scenario, 0.02 of 5 pounds is just 10 pounds. It's just 10 pounds here. It's just 10 pounds. So, since our account is dominated in the pounds, our risk is going to be 10 pounds. So, if first exchange, we need to exchange this and convert it into US dollars. We need to first convert the 10 pounds into the dollars. So let us look at the exchange rate of pound USD to see what's the value of 10 pounds in $10. If you look at the MetaTrader 5 here, on the currency pair, which is pound USD, at the ask price, the exchange rate, which is 1.22083, which is 1.22083. This is the exchange rate of pound USD. So since the pound is greater than the dollar, therefore we multiply. Therefore, we are going to multiply this times 10 pounds to get the value in dollars. We calculate here. Let me pull out the calculator. Cancel this, which is 10 pounds times 1.22083. 1.22083, which is the exchange rate of pound USD. This now we are getting, this is 12.28. We're getting 12.2083. This value here. This is how much you get if you exchange $10. If you exchange 10 pounds into dollars. If you exchange 10 pounds into dollars, you get 12.2083. That means if you want to trade pound USD and your account is in pounds, you need to first exchange how much you risk per trade, which is 10 pounds, which is 2%, into the USD. And by exchanging that, you get $12.2083. Let's take a scenario. Where your technical analysis is giving an entry of 50 pips. That means we calculate the pip value. The next step is calculating the pip value. We calculate the people value by dividing how much we put per trade, which is 12.2083 divided by the pips. So we divide this here, what we get is the pip value. So let us divide this by 50 pips. Divide by 50 pips, which the technical analysis gave us. That means our pip value is 0.441. Our pip value is 0.441. That means you're going to, each pip value we lose is going to be equivalent to 0.2441, and we are going to lose, if we are getting money, making a profit, is going to be 0.2441 per pip. After calculating the pip value, we calculate how much the position is going to be, and then we get the actual lot size. By getting, so we multiply this. So we get the pip value times the known units, which is 10,000. This value here is the known units in the currency pair to fit the standard deposition. So we multiply this by the known units, which is 10,000. So this value over here which is 2401.66, is the entire position we are going to have at 2% on the pound dollar. So this is the position size here. We are going to have a 2% in the pound dollar. So to apply this correct position sizing, we need to get the lot size. But to get the lot size, we divide this position size by the standard, which is 100,000. So let us divide this value here. So we divide this by 100,000. Let's divide this by 100,000. Which gives us 0.024. This is how much, this is the lot size we need to put into your trading platform. This is the lot size you need to put into your trading platform to make sure you don't risk more than the 10 pounds you have on your actual trading account. Let me put it down here. This is the lot size. So this is the actual lot size here. You need to apply into you need to put it into the trading platform with your broker. That means your position size is going to be 0.0. You're going to apply 0.024 micro lots in your broker to make sure you lose 2%, or you apply the correct position sizing. So let us prove this formula here. We prove it by getting the pip value, which is here. Let us prove the formula. Let us prove the formula. Our people value, which is our people value, our people value our people value over here, which is 0.2441. We are going to multiply it by the 50 pips. We are going to multiply it by the 50 pips. Our technical analysis gave us in this case this value here, which is in this case the people value. Let me pull out the calculator over here. Let us prove this formula. Then you're going to multiply it by the 50 pips. 50 pips. This is the amount we have at risk in dollars. This is the amount we have at risk in dollars. The amount we have at risk in dollars, which is 12.2083. So to prove the formula correctly, because since we are trading the pound dollar, that means the dollar is the quote and the pound is the base. By trading the pound dollar, that means we are making money and we lose money according to the dollar rate. That's why I had to convert the pound at risk into the dollars. So to prove the formula, to complete it, I have to convert the 12.083 into pounds by dividing. Since the pound is greater than the dollar, that's why we divide. And if we want to convert the dollars into pounds, we multiply. So the exchange rate of the pound USD, which is 1.22083 over here, is the value we need to convert the dollars into pounds. So let us convert this. So we divide this in 1.22083. 1.22 0.83. We have 10. We get 10. We divide that by 1.22083. The value we get is 10. The value we get is 10. You see, the formula is just proving itself right away. The formula is just proving itself right away. And that means we are just losing our 10 pounds. 10 pounds per trade. 10 pounds per trade is what you have at risk. I never thought this video is going to go as much as this. And because I want to put emphasis on risk management, because we need to put it in place. We need to put it in place to make sure we are profitable. Risk management is inevitable. We are always prone if you deviate from the system. Let me give you my advice. If you are a trader, you need to trade according to your account. If your account is dominated in the dollars, if your account is in the dollars, for example, dollar is a commonly traded pair, I advise you trade currency pairs where the dollar is the quote. Where the dollar is the quote. What I mean by being where the dollar is the quote, for example, if this account in this currency pair here, this is the pound USD, the pound USD. the dollar is the quote and the pound is the base. Because if your account is dominated in dollars, for example, which is $500 here, 500 USD, and then we risk 2%, which is 0.02%, 0.2%, 0.2%, giving us $10. We need to risk per trade. If you are trading a currency pair where the dollar is the quote, for example, which is the euro, if you want to go long or go short on euro USD, and the dollar is the quote, and your account is dominated in the dollars, in this scenario, you do not need to convert your risk into dollars because the dollar is already the quote in the currency pair that you are trading. In this scenario, you just get the 10. In this scenario, you just get the $10 you have at risk. You just divide it by the pips. In this example, we are using 50 pips. You divide it just by 50 pips. 50 pips. 50 pips to get the pip value. Oh, sorry. In this scenario, if we divide 50 pips, we divide to get the pip value, we get the amount at risk divided by the pips, which is 50. The value we have is 0.2. 0.2 is the pip value. 0.2 is the pip value. Implying that you are going to make money and you're going to lose money in according to pip value, which is 0.2. You lose money and gain money in 0.2 value per pip. In this scenario, let us calculate the position size. Calculate the position size here. The position size. To get the position size, we multiply the pip value times the known units, which is the 10,000, and then the actual value we get times 10,000 here on the calculator, we get 2,000. 2,000 implies 2 micro lots. So we are going, so in trading this pair, to make sure your risk doesn't go beyond $10, your position size has to be 2,000 in size. 2,000 in size. So to make sure you put this correct position size, we need to calculate the lot size as well. To get a lot size, we divide the position we have got here, the position size here, divided by the standard size, which is 100,000, and then the value we get divided by 100,000, and then the value you get here, which is 0.0 which is 0.02. That means in your account, in your MetaTrader 4 with your blocker, you need to drop a lot size, which is 0.02. In the next video, we're going to be talking about leverage. Managing risk is the oxygen you need as a trader to make sure that you are alive in the market in the long run. And then trading professionally means following the system, trading psychologically stable, and then managing risk without exceptions. My name is Regan. This is High Fund. Please like and subscribe for more content. This channel is here to elevate your trading skill. Thank you.